So welcome to the financial reporting and analysis. And today's topic will be about the group account or the consolidated statement or the consolidated group statement or the business combination. So I want to welcome you to this class of the group account. So we shall start from the introduction, and then afterwards we shall do some questions from our past paper. So welcome again. So welcome to the class of business combination. You can also call it consolidated statements of group accounts, of the group accounts, or you can call them the business combination. So whichever words you want to go with it, you can use it. But group account or the business combination is mostly the words that are used in a lot of cases. Now, when we talk about group account, we need to talk about what is group account or what is the business combination. Now, when we talk about group account or business combination or consolidation, it refers to the bringing together of separate entities. So, bringing together separate entities into one reporting entity. So, this is the process of bringing two separate entity to one entity. How is it achieved? It is achieved by consolidating the statement of one company with the statement of another company to make the statement to be as if it were prepared by one entity. That one is okay. So just remember that when we talk about the business combination, we're talking about the process of bringing together separate entities into one reporting entity. Now, what is the objective of this group account? Now, the main objective of business combination is to enable the acquirer company to report on the operation of the acquiree company as if they belong under one economic entity. So the entity which controls another entity uh, bring together the operation so as to make them as if they operate under one economic entity. So that's the main objective. So the objective of the business combination is to enable the parent company to report the operation of the subsidiary company as if they belong under one economic entity. Now we have some definition term. For example, we have definition like parent company, we have subsidiary, we have joint ventures, we have the associate, and we have the investment. Now, for subsidiary, this is where the parent company control at least or more than 50% of the shareholding. For joint venture, the company controls 50% of the shares. Then for associate, the company control more than 20% and less than 49%. So between 20 to 49. Then we have the simple investment, or we call them the investments of the companies. So the company control between 0% to 19%. For subsidiary, um, it is prescribed under IAS 27, International Accounting Standard 27. For joint ventures, that is International Accounting Standard 31. For associate is International Accounting Standard 28. Then for simple investment is International Accounting Standard 29 and 32. Now let us write something down concerning group account. Let us write something down concerning group account. So as you can see, we have some notes in our board. Uh, so that is the definition that we said, that the group account is the act of bringing together different or separate entities into one reporting entity or into one economic entity. What are the main objectives of group accounts? So the main objective of business combination is to enable the parent company to report the operation of the subsidiary as if they belong under one economic entity. I've decided to use the word subsidiary and the word parent because the requirement by the IAS is we need to consolidate the accounts of that of the parent and subsidiary. So the rest cannot be joined together. So or cannot be brought together. But the one for the parent and the one for the subsidiary, we must consolidate them. So we pick the amount of the parent and we add with the amount of the subsidiary. We shall see it later. Now, investment of ordinary shares amount to control of the business. So when the company invests their shares in another company, it will amount to control. But if they invest in other form of capital, for example, loan stock and preference shares, then it will not amount to control. It will not amount to control. Now, the aspect of investment in ordinary share is what brings this aspect of control. So, for example, we have the parent company. The parent company is the company which control another entity. Then you have the subsidiary. Subsidiary is where the parent owns at least 50% of each share. When I say at least 50%, I mean from 51 up to 100%. That is under IAS 27. Then we have the joint venture. The parent control exactly 50% of the company shares. It is prescribed under International Accounting Standard 31. Then we have the associate. This is where the company control between 20% to 49% of the shareholding under IAS 28. Then you have the simple investment. This is where the company holds the shares between 0 to 19% under IAS 29 and under IAS 32. So let's define what is parent company. Let us define a parent company. So a parent company is a company which obtains the controlling interest in another company. So we say this is the company, this is the company, this is the company which obtains the controlling interest, in another company or entity, or company. For example, this parent company has obtained control over the subsidiary. It is controlling 51% up to 100%. Also, for joint venture, it has obtained control of 50%. That is correct. We can also talk about what is a subsidiary company. We can define what is a subsidiary company, and we say a subsidiary is an entity that is controlled by another entity. So a subsidiary, this one, is an entity that is controlled by another entity. That other entity is called the parent, which is at least 50% by another entity. More than, you can see more than 50%. So more than 50% of its equity capital. That is the definition of the subsidiary that you can find. We can also find another definition of a joint venture. Let's see if we can have a good definition of a joint venture. Then we say a joint venture is an entity. So we can also write that one here. So the first one was subsidiary. The second one is joint venture. J means joint venture. We say it's an entity. Which the parent which the parent control exactly controls exactly 50% of its equity capital or the shares. So that is the joint venture. So when we talk about the joint venture, remember we are talking about an entity where the parent company control exactly 50%. Then we have another one which is called the associate. Associate. Uh, so when we let us define an associate. So for associate, there is a significant influence. So the parent has the significant influence. Also to joint venture, the company has a significant influence to that company, and the company controls exactly or more than 20% or more than 19%, but not not more than 49%. We can say is an entity where the parent controls uh, more than 19%, but uh, not exceeding 49% of its equity capital of its equity capital. Same will apply to simple investment. Simple investment. So a simple investment is an entity where the parent controls more than between zero. So that was between 0 to 19%. 0 to 19% of its equity capital. So this one is where it's an entity where the parents control between 0 to 19% of its equity capital. Now you need to know this. Under subsidiary, the company has full control. So under subsidiary, the parent has full control. The parent has full control of the entity. So the company controls the subsidiary fully. Whether it is 50%, 51%, 70%, 80%, or 100% control, whichever the aspect, if it is 50, 50, sorry, not 50, 50 is joint venture. Either it is 51 or 55 or 60 or 70 or 80, 90, or the parent control 100%. Well, regardless of the percentage, the parent company always controls subsidiary fully. There's a full control. But for the others, the parent has significant influence. So for the others, the parent exercises a significant influence but cannot control them. So for the rest, now for subsidiary, we have said that the parent company has full control over the subsidiary, regardless of the of percentage of ownership. So regardless of the ownership percentage, the company fully control the subsidiary. What about the other three? The joint venture, the associate, and the simple investment. Now for those, for these two items, for this we say for joint venture, comma, associate, and simple investment, we can say that the parent exercise a significant the parent exercise exercise exercise, I don't know if that's the correct spelling, exercise a significant influence, a significant influence, but cannot control the entities, but cannot control the entities. So these are some of the things you need to know. So for when it comes to subsidiary, associate, joint ventures, and simple investment, it is only under subsidiary where the company control where the company controls fully the subsidiary. But for the others, they have just significant influence, but they cannot control the entities. Now, I think we can look for the structures before we continue. Group structures. So group structures, which is important. Group structures. Group structures. Now, the first one we can talk about, we have three types of structure. Number one, we can talk about the horizontal structure. Horizontal structure. For example, we have a company called P, which is the parent. We have another company which is called the subsidiary, P Ltd, S Ltd. Then we have another company here, which you can call it A, J, call it J Ltd. And then we have another company, which we can call it A Ltd. So P Ltd is a company which controls S, J, and A. Now that structure is what we call the horizontal structure. Now the company controls those company. So this is where the company has a controlling interest in more than one subsidiary. So we talk about the horizontal structure occurs where the parent acquires controlling interest, in more than one company, one entity. That is the word entity. So for example, hold 80% here as a subsidiary, 50% maybe as a joint venture, then 45% as an associate. So the company controls the P company controls S company 80%, also control J company 50%, and ALTD 45%. So that's a good example of horizontal structure. Then we have vertical structure. Number two, vertical structure. Now, in this case, this occurs where the parent acquires a controlling interest in a subsidiary, and subsidiary acquires another controlling interest in another subsidiary. So this, when we talk about vertical, this is where the parent company has acquired a subsidiary. Then a subsidiary has acquired another company. So meaning, the company which is controlling the subsidiary also is controlling the subsidiary indirectly. So we can define it as this occurs where the parent company acquires controlling interest, in a subsidiary, and subsidiary and the subsidiary acquires a controlling interest acquires a controlling interest. Acquires a controlling interest in another subsidiary. In another subsidiary. So that one is correct. So one company, let us now do an example. P Ltd, just go with our acquires S Ltd 80%. Then S Ltd acquires A Ltd maybe 60%. So remember, P is the main company which acquired S. So S is a subsidiary of P because it controls more than 80%. But also S has acquired A. So remember, A is a subsidiary of S. Also, it's a subsidiary of P. Now, but remember, A is a subsidiary of S. Now, but we have what we call an indirect control. So, as much as P control S and S control A, P through S controls A indirectly. So, P through S control A indirectly. So, how do we know? So, we can do this. We can say, this is what we can say. Let us write it here. We can say that A controls B. A controls B 80%. Then we have the NCI share. The NCI share is 20%. So remember, P control S 80%. But then we have what we call the NCI. The NCI is 20%. The amount that is not, the proportion held, not held by the parent. So the parent hold 80%. Then there's the proportion of share that is not held by the parent. It's what we call the NCI. So P control S 80%. Then we have an NCI share of 20%. Then we have A control C. So how does it control C? It will be 80 times 60, which is 48%. 48%. That is 48%. Now this 48% is what we call the, so C, not C. What am I saying? P control, this is supposed to be P, A. P controls C 80%. P controls S, not C, S, sorry, S. P control S 80%. Then you have the remaining, which is the proportion of the shares not held by the parent, which is the NCI, non-controlling interest, is 20%. This is called the non-controlling interest. So we talk about non-controlling, we shall define it a bit. It is the proportion of shares not held by the parent is 20%. So the parent holds 80. Now that is the aspect of control. So P control S 80%. Then S control A. S control A by how many percent? So you take 80 times 60, that is the vertical. So 80 times 60, which is 48. So not P, not S, supposed to be P. P control A, but remember this is an indirect control. So P controls A indirectly at which rate? 80 times 60, which is 48%. That is 48%. Now that for this aspect of indirect control, it will be of no importance in this level, but you can find it in advanced level. Also, you can have, for example, let's say this one is 90%. Let's assume that that is 90% now, and not 60. Meaning, in this case, it will be 80 times 90, which is 72. Now, meaning A, because 72 is between 51% to 100%, we can say that A is a subsidiary of P. That A is a subsidiary of P. A is a subsidiary of P. Reason why? because when you take the share of P to A, 80 times 90, it is more than 51%. So it becomes a subsidiary. So S is a subsidiary of P because P controls S. But A is controlled by P indirectly through S. Then A becomes a subsidiary because it is controlled indirectly from the parent company through another company which is controlled by P. That one is fine. Then we have the mixed structure. Then we have the mixed structure. The mixed structure. This occurs where the parent acquires a controlling in a subsidiary, and a subsidiary with the parent acquires a controlling interest in another subsidiary. So this is how it looks like. Mixed structure. Mixed structure, and we say you can see this. This occurs. This occurs where the parent acquires. Where the parent acquires a controlling in subsidiary. Acquires a controlling in subsidiary. A subsidiary with the parent. And subsidiary with the parent. And subsidiary with the parent acquires controlling interest. Acquires controlling interest. Acquires controlling interest in another subsidiary. In another subsidiary. Let us give an example. So we have company A acquires company B 80%. Then A acquires C, and also B acquires C. So this one acquires to it 25%, the other one acquires it 40%. That is what we call the mixed structure. So this is where the parent acquires a subsidiary with the parent acquiring the interest in another subsidiary. That one is correct. Now we can say with this what we can say. Now A has interest on C. So A has interest on C. How? The first one is A to C, which is 25%. Then A through B through C. So A controls C direct, and also A controls C through B, which is 80. 80 times 40%, which is 32%. Meaning total is 57%. So that's how, and that one is a subsidiary. So remember that one is a subsidiary, and therefore C is a subsidiary of A. C is a subsidiary of A. So as much as 25% is not meant for subsidiary, but when we take the share of 25% direct and the indirect control of A through B to C, which is 80 times 40, then we add, we shall get an amount which is more than 51, which is 51% and more. So meaning the 57 is more than 50%, and therefore C is a subsidiary of A. So those are the three group structure that you only need to know at this point. But the first one is what you really need. This one, you really need this one. Then for this C, we have NCI of 20%. So the rest do not have NCI, the non-controlling interest. So it is only the subsidiary which has the minority share. The rest do not have the minority share. The minority share is the NCI. So the proportion of shares which is not held by the parent. NB, only subsidiary is consolidated and for the ordinary share capital of the shares, only for the parent is recognized. So that you need to know that one. Only the subsidiary is consolidated, and I think I said it somewhere. I don't know if I said it, but you need to know that when it comes to consolidation, we only consolidate the one for parent with the one of subsidiary. So you need to know that one. So we only consolidate the operations of those of the parent with that of subsidiary. That one is fine. I think up to that point we have covered all the group structures. Maybe we can talk about the. You can define what is a subsidiary. Now, a subsidiary is a company acquired by a subsidiary company of the parent. So, a subsidiary is a company acquired by the subsidiary of the parent. So, when a subsidiary of the parent acquires another company, that company becomes a subsidiary. I don't know if it will share here subsidiary. So that means it means that it's a company or an entity. That's the word entity acquired. So an entity acquired is an entity acquired by a subsidiary, by a subsidiary, by a subsidiary entity of parent entity. The parent entity. That is it. That is it. I think at that point it is not bad. So let's talk about the IAS 27 a bit. Just a small portion, just a small aspect of IAS 27. So IAS 27, let's talk about it just a minute. It's about the accounting for the subsidiary. So IAS 27. Now, before we talk about the IAS 27, as you can see in my board, we have something to do with control. Now, when we talk about control in group accounts, we are talking about the power to govern the financials and operating policy decision of the investee. So that is how the parent has the power to control the subsidiary in most of the situation. Now we have the consolidated financial statement. These are the financial statement of different or group companies presented as a single entity or presented as a one. Then you have the group. Remember, the group account is the process of bringing together the financials of different entity and then present it as one. But when we talk about now group means this comprises of the parent company and all its subsidiaries. Then you have the NCI or the minority interest. So this one you can call it the minority interest. Let's move the word share. Let's call it minority interest. So the NCI, non-controlling interest. So the word NCI means the non-controlling interest. This is the proportion of the net asset in the subsidiary that is not owned by the parent or the parent does not control. So we shall talk about it later. Now, IS 27 requires that the group account of the parent and those of subsidiary to be combined and presented as a single entity. This is very, very important. So you need to know when you are doing the group account, you need to take the values of the subsidiary, you add it with the value of the parent, even if the parent does not own 100%. As long as it's a subsidiary, meaning as long as the parent owns more than 51%, 51% and more, then whatever the proportion of ownership, if it owns 100% or 51 or 70, you need to combine the the accounts of the parent with the account of subsidiary to make it one, even if the parent does not own 100%. So even if they hold 99, 51, 52, you do the same. Now, the proportion not held by the parent is called the NCI. We have just said, or sometimes called the minority interest. So the NCI, as I have said, is the non-controlling interest, and it is treated as current liability in the statement of the financial position in the balance sheet. So NCI will be a liability to the entity, that is the parent company. Now, let us now see. So if we have P Ltd controlling S Ltd 72%, then the NCI will be equal to what? The NCI will be equal to the remaining amount. So 100 minus 72, that is 28%. So this 28% is what we are talking about, the proportion of the net asset not controlled or not held by the parent company. Now, if it is 70%, for example, then the NCI is 30%. The NCI is 30. If it is 90%, the NCI is the 10%. The NCI is the 10%. The NCI is the 10%. Let us see the exemptions. Exemptions where exemption. So exemptions will be our next jump. Exemptions. So some of the exemptions that we can have, we can find them under the Company Act, the Section 154, the Cap 486, or we can find it under the RIGO framework. This is supposed to be the RIGO framework. You can find it under the RIGO framework, or you can find it under the institution frameworks, which is prescribed by the IS. Now, these are the exemptions. Now, when the company is not trading its shares in the public market or in the foreign market, or also in the foreign market or in the local market here, which is the public, then that company, even if it's a parent company, cannot prepare the consolidated statement unless their shares are in the market. Number two, where the parent is a subsidiary of another company. For example, we had P control S 80%, then S control A 70%. So remember, S is the parent to A, but remember, S is controlled by P, meaning S does not prepare the financial statement. The person who prepares the financial statement for S is the company P, and therefore S cannot prepare the statement for A. It cannot prepare the statement for A. So in that case, so the parent itself is a own subsidiary. So when it is a subsidiary of another company, but it has the parent company, then it cannot prepare the statement. The person who can prepare the statement is the P company or partial. Debt instruments are not traded in the local, foreign, or the public market. Also, it's another reason. It's an investing company. An investing company is a company which has a lot of investment. Now, when the company has a lot of investment, it means it is very hard to prepare the statement of each of all the investing company around. For example, when you have something like these investment companies, Cyton, Britam, you find they have a lot of real estate where they own more than even 70%. So they have real estate in this place, in another place. They have like 50 real estate where they fully control those real estate. Meaning, preparing those statements will be very, very, very hard. As combining 50 subsidiary is hard. Now, in that case, it is exempted from preparing the consolidated statement because it will be very hard. So each subsidiary will operate on itself because of the workload and the time for this company to consolidate all the statement of all those other companies will be hard. Then, if the company has not filed or is in the process of filing to the commission any issue or class of instrument or shares, so if they have not filed any shares or they're in the process of filing any class of shares or instrument, then unless it is already in the market, they can prepare. But if they have not or they are in the process, it means they cannot prepare the consolidated statement. Then each ultimate or intermediate parent prepares the consolidated statement. Now, in the case where the parent company automatically prepares the statement, then the other company, even if it's a parent for another company, will not prepare the statement. A good example is this one. Now, this one is a parent, but the ultimate parent company, which is P, has prepared the statement. Therefore, S will not prepare the statement. So those are some of the exemptions that you might find when we talk about these items. NB, you need to know this one. NB, capital account is not consolidated. So NB, capital account, that is the ordinary share capital, and retained and not retained earnings and share premium are not consolidated. You take the full amount to the parent direct. So you take the full amount directly to the parent. So you take the full amount directly to the parent. I think that is all about it. I don't think there is anything that is required. Another reason where the we cannot the company cannot prepare the group financial statement or the consolidated, where the acquisition is made to last less than 12 months, where the acquisition is meant to last less than a year, less than 12 months. So in that case, this subsidiary is acquired today, but it will not be there in the next 1 year. After 1 year, it will not be there. Then it is not a requirement to prepare the consolidated statement of that company. Now, I think our next jump will be talking about the consolidated statement of the financial position and adjustments. So some of the adjustments that we need when we shall be doing what we call the consolidated statement of financial position. So key adjustments. So key adjustments will be our next subtopic. Key adjustments. So circumstance under which the company is deemed a subsidiary. So that one you can find it. So this is where the company controls more than half of the shareholding entity. That's number one. So more than half meaning 51 to 100%. Then where we have the representation of the parent company to the BOD of the subsidiary company, board of directors. So where the company has a representative in the board of directors of the subsidiary company. So in case they have meeting, blah blah blah, they are there. So meaning they have control. And then where the participation in the financial and operation policies of the subsidiary. So where the parent also participate in the financial and operation activities or the policies of the subsidiary company. So I think this one will mark the end of lesson 1. So lesson 1 will end to this point. So lesson 2 will start with the key adjustments, which is very important, of group accounts. Key adjustments of group accounts. So all those key adjustments that we shall talk about, it is what you shall find in your additional information when doing acquisition of group account. So you be very keen, because those adjustments are the one which you shall find in the additional information when tackling the question of a group account. So with that one, I think mark the end of lesson 1. We shall meet for lesson 2. We shall start from this point. I think maybe we can try and mention some of those adjustments. Let me see if we can mention some of those adjustments that you can find, or we just mention in our next Let me see. Yes, we can talk about the unrealized profit on stock. Profit on stock. Number two, talk about unrealized profit on fixed asset. So in the UPS, there you have unrealized profit, profits on fixed asset, UPFA. So that is the UPFA. And number three, you can have intergroup owings. Intergroup owings. Number four, you can have fair value measurement. Fair value measurement. This is about revaluation. When we talk about the fair value measurement, we're talking about revaluation. We are talking about revaluation. So intercompany debt, unrealized profit on closing stock, intercompany sales of fixed asset, fair value adjustments. Number six, we can have goodwill. Then number six, dividends. So once we manage to do all this, so UPFA is unrealized profit on fixed assets. So once we manage to do all those 6 items, then we shall be done with the group account. So with that one, I want to wish you well. Let us meet in our lesson 2 of the group accounts.